I don't think people understand the repo rate. Decoding the mystery. What is a repo rate? Imagine you're a superhero in dire need of cash. You rush to the reserve bank of superheroes. This bank lends money to other banks, just like superheroes need power-ups. The interest rate they charge? That's the repo rate. In simpler terms, the repo rate is the interest rate at which the central bank, like India's Reserve Bank, lends money to commercial banks. Think of it as the master interest rate influencing all other interest rates in the economy. This rate is a powerful tool. It controls the flow of money, much like a faucet controls water. By adjusting this rate, the central bank can either stimulate or slow down the economy. The repo rate dance. How does it work? Commercial banks, like the ones you use, often need extra cash to meet requirements. They borrow from the central bank, promising to repurchase those funds later with added interest. This repurchase agreement gives the repo rate its name. When the central bank increases the repo rate, borrowing becomes expensive for commercial banks. They pass this cost on to you and me, increasing interest rates on loans. Conversely, a decrease in the repo rate makes borrowing cheaper, leading to lower interest rates for us. It's like a chain reaction. Ripple effect. Repo rates' impact on the economy. The repo rate is like the conductor of an orchestra. It influences various economic instruments. One of the most significant is inflation. When inflation is high, the central bank might raise the repo rate. This makes borrowing expensive, discouraging people from taking loans and spending excessively. Demand cools down and prices stabilize. On the other hand, a low repo rate encourages borrowing and spending, boosting economic growth. However, if not managed carefully, it can fuel inflation. Section 4. Repo rates and you. From student loans to that cup of chai. You might be thinking, how does this affect me? Well, buckle up. Remember those student loans you or your friends might take. Their interest rates are influenced by the repo rate. A higher repo rate means higher EMIs, while a lower one translates to some savings. Even the price of that cup of chai you enjoy is indirectly influenced by the repo rate, as it affects businesses' borrowing costs. From buying a new phone to planning a trip, the repo rate casts a long shadow on our spending power and financial decisions. Section 5. Repo rates in the real world. Recent examples from India. In recent years, India has witnessed the impact of repo rate changes firsthand. The Reserve Bank of India, RBI, increased the repo rate to combat rising inflation caused by global factors. This move aimed to control price rises and stabilize the economy, even if it meant slightly higher loan rates temporarily. It's like hitting the brakes on a speeding car to prevent an accident. Understanding these real-world examples helps us grasp the significance of the repo rate in our lives. Section 6. Why should students care about this financial jargon? You might be wondering, why should I bother with this financial jargon? Well, as future leaders, entrepreneurs, and informed citizens, understanding the repo rate empowers you. It helps you make informed financial decisions, from taking loans to planning investments. It enables you to understand the economic landscape and the rationale behind government policies. So the next time you hear about the repo rate in the news, remember, it's not just another economic term. It's a powerful tool that influences your life and the world around you.